We regret to inform you that your firm is finished.
This is plunder.
In a world fueled by intense rivalry and aspiration, one company has persisted for over 100 years, evolving into the quintessential symbol of Wall Street. Both admired and despised, it became known as the finest risk manager in the financial realm. The company's culture was shaped by a strong sense of discipline and unwavering determination, where achieving victory often meant that others had to face defeat.
This is Wall Street. Sign the agreement.
In the year 1886, after earning a modest fortune from his clothing trade, a Jewish immigrant named Marcus Goldman turned his gaze towards the world of finance. Marcus Goldman saw a rising demand among small businesses that faced challenges in turning their receivables into instant cash. During that period, banks provided only restricted access to credit, resulting in many merchants lacking the necessary funds. Marcus Goldman entered that space, buying their short-term debts at a lower price and subsequently selling them to investors and bankers for a profit.
In 1886, Marcus Goldman saw opportunity in the scarcity of credit.
These transactions developed into what came to be known as commercial paper, a groundbreaking method to offer short-term capital. It was the beginning of the investment banking era. In contrast to the traditional commercial banks that provided careful and secure lending, firms like Goldman Sachs embraced higher risks for the chance of greater rewards.
The late 19th century demanded capital. Commercial paper offered a tantalizing. By the late 1880s,
Within a span of 10 years, Marcus Goldman grew his business to manage almost $30 million worth of commercial paper annually, laying the groundwork for a financial empire that would eventually influence the future of American banking.
Cemented his empire.
This secures the dynasty, Samuel. It is
By the time Marcus Goldman reached the age of 60, he had already outlived the average man of his time. Determined to ensure the survival of his business long after his retirement, Marcus Goldman invited his son-in-law, Samuel Sachs, to join him as a partner. Under the leadership of Samuel Sachs, the firm thrived. By 1896, Goldman Sachs held $1,500,000 in capital shared among 5 partners. However, the market for issuing and trading commercial paper had grown crowded, and there was a need for new opportunities for growth. As the 19th century drew to a close, a new chapter in finance began to unfold. The process of bringing private companies into the public eye through what came to be known as an initial public offering. In simple terms, an initial public offering allowed a small private firm previously owned by only a handful of individuals to sell shares to the wider public. Investment banks played a crucial role in this process, providing advice to the company and underwriting its stock to successfully bring it to market.
They may deny us entry, Samuel.
During that period, the initial public offering business was largely controlled by esteemed European banking institutions. As a Jewish partnership operating in America, Goldman Sachs was seen as an outsider among those elite firms, yet Marcus Goldman and Samuel Sachs would not allow themselves to be left out. They were filled with ambition, brimming with resourcefulness, and eager to demonstrate their capabilities. Their initial bold move into this new world would be to take a Jewish-owned company public, signifying the start of a new era for Goldman Sachs and for American finance. In 1897, the retail company Sears had a modest net worth of $250,000. Within less than a decade, by 1905, Sears had grown into a powerhouse, generating $37 million in revenue and nearly $3 million in profit. It was an ideal candidate for a public offering.
Amidst the dawn of a new century.
Taking Sears public, however, would present a challenge greater than what Goldman Sachs could tackle on its own. To make it possible, Marcus Goldman and Samuel Sachs decided to partner with another rising Jewish financial house, the Lehman Brothers. Together, Goldman Sachs and Lehman Brothers underwrote $30 million in common stock and $10 million in preferred stock for Sears, a monumental transaction for the time.
Amidst the monumental costs of the Panama Canal and
the agreement was a great success. Both firms earned unprecedented fees, and the success transformed their reputations. In the years that came after, a growing number of major companies looked for their services. By 1914, Goldman Sachs had established itself as one of the prominent investment banks on Wall Street. Henry Goldman, who is now the senior partner, was even invited to take part in the creation of the United States Federal Reserve System. Yet the investment banking business moved in cycles. After earning millions in fees from issuing stocks and bonds, Goldman Sachs found itself in search of new paths to reinvest its expanding capital. The timing could not have been better, for the nation was entering the Roaring Twenties, a period of dazzling prosperity and unshakable optimism. It felt as though America had entered a contemporary Emerald City, where riches appeared boundless and chances seemed infinite.
The Roaring Twenties ushered in a wave of optimism that enveloped America. It was a time filled with dreams and uncertainty when markets climbed high and wealth appeared to come easily. Anyone could borrow, invest, and dream of riches. Goldman Sachs, ever watchful for opportunity, chose to take advantage of the moment.
The firm established a trading corporation, starting with $1 million of its own capital, and subsequently offered shares to the public at 10 times that value. In doing so, Goldman Sachs raised $93 million, turning its original stake into nearly $10 million overnight. It was financial engineering at its boldest, an early version of what would later be known as a special-purpose acquisition company. The formula was straightforward: purchase, sell, and continue as long as the market maintained its faith. Investment trusts emerged one after another, driven not by real value but by the excitement of the public. Investors gathered eagerly to purchase anything that was available, firmly believing that prosperity would last forever. America felt confident that it was approaching a definitive triumph over poverty itself. However, prosperity founded on illusion cannot endure indefinitely.
fueled by the explosion of
On the 29th day of October in the year 1929, the illusion shattered. The stock market fell apart, wiping out fortunes in a single night. Factories closed, workers found themselves facing unemployment, and despair spread throughout the nation. Marriages saw a decline, suicides experienced an increase, and confidence in the American dream wavered. The Goldman Sachs Trading Corporation, which was once a symbol of success, came close to being completely wiped out. Many millions of dollars disappeared, and the firm lost $13 million of its own capital. Within a year, numerous investment trusts went bankrupt, bringing their investors down with them. Yet somehow, Goldman Sachs persisted through the challenges. The survival of the firm can be attributed largely to one individual, Sidney Weinberg, a native of Brooklyn, who overcame poverty to emerge as one of the most resourceful leaders in the firm's history. Sidney Weinberg was the third child in a family of 11, navigating life in a Brooklyn household facing challenges. In order to assist his parents and siblings, Sidney Weinberg made the decision to leave high school before completing it and sought employment wherever opportunities arose. Even as a young person, he displayed an exceptional determination and an innate ability to relate to others. Sidney Weinberg's journey with Goldman Sachs started at the very beginning as a caretaker. Yet within 15 years, through persistence, charm, and relentless ambition, he ascended to the pinnacle of the firm. Sidney Weinberg's knack for building authentic connections rendered him essential. Individuals placed their trust in him, held a deep admiration for his determination, and genuinely enjoyed his company.
Very good, Mr. Weinberg.
Even amidst the Red Scare,
With that remarkable talent, Sidney Weinberg drew in a notable array of clients, securing some of the most significant investment banking deals in the nation, such as the public offering of General Electric. Even after the devastating collapse of the Goldman Sachs Trading Corporation, those clients remained loyal. They had faith in Sidney Weinberg and in the organization he stood for. The firm's remarkable recovery only intensified Sidney Weinberg's desire for success. Now he set his sights on something that no one else had achieved, taking Ford Motor Company public. The Ford Motor Company, established by the groundbreaking industrialist Henry Ford, transformed the way America traveled. Henry Ford had a dream that was both simple and bold, a car in every driveway. By 1956, Ford had grown to be the second largest car manufacturer in the nation, and its initial public offering was set to be one of the most profitable in history. However, there was a problem. Henry Ford always held a deep disdain for Wall Street, seeing it as a place filled with gamblers and con artists. Even the powerful J.P. Morgan Jr. had not succeeded in persuading him to go public. Although Henry Ford's vision changed the course of industry, his personal biases were widely recognized. He was an exceptional businessman, but not particularly compassionate. 9 years following the passing of Henry Ford, the company was handed over to his grandson, Henry Ford II, who was a more progressive and contemporary leader. For Sidney Weinberg, this was the opportunity of a lifetime, a chance to accomplish what the greatest financiers before him could not. The 1950s marked a turning point for Goldman Sachs when the firm was chosen to underwrite the public offering of Ford Motor Company, an extraordinary milestone considering that Henry Ford had once been known for his hostility towards Jewish financiers. This moment marked a significant shift on Wall Street, acknowledging that skill and trustworthiness could rise above past biases. The Ford offering turned out to be a remarkable success, and as profits flowed in, Goldman Sachs looked for new opportunities to grow its wealth. Inside the firm, a small yet determined trading department had started to achieve impressive gains. The leader of the department was a man whose name would eventually become legendary in the financial world, Gus Levy. The nation was experiencing a fresh golden age. Following years of struggle and conflict, the nation embarked on a time of remarkable industrial growth. Wall Street flourished, directing the influx of capital into businesses that shaped the contemporary American economy. Goldman Sachs, having already guided giants such as General Electric and Ford Motor Company to the public markets, now stood among the most powerful investment banks in the world. Yet, for Goldman Sachs, success was never merely about profit. Inside the firm, competition was a guiding principle. The partners and traders gauged their value not by the amount they earned, but by whether they triumphed continuously, unyieldingly, and without fail. Winning was everything, and falling behind was unimaginable. As Sidney Weinberg kept bringing in significant investment banking clients, Gus Levy advanced in his career with an innovative method of trading called block trading. His approach and outlook would soon transform the company's future and reimagine the very concept of risk on Wall Street. Gus Levy was born in the month of May in the year 1910, coming from a humble middle-class family in New Orleans. From a young age, Gus Levy dreamed of reaching New York City and making his mark among the financial elite. By taking bold yet thoughtful risks, Gus Levy realized that dream. By the age of 30, Gus Levy had already become a millionaire and a respected partner at Goldman Sachs.
I'll absorb the entire block at a 6-point. I want the entire block.
Gus Levy's strength was in innovation, especially in a trading method called block trading, a complex form of arbitrage. Gus Levy found that when big investors attempted to sell large quantities of stock, the market frequently responded aggressively, causing prices to drop significantly. Rather than allowing that situation to unfold, Gus Levy would engage in private negotiations with those investors, acquiring the shares at a reduced price and subsequently selling them slowly into the market for a profit. The gains on each deal were modest, yet with Goldman Sachs's access to considerable leverage, those modest profits grew into substantial earnings. By the early 1960s, as Sidney Weinberg approached retirement, Gus Levy had emerged as his natural successor. For the very first time in the firm's history, a trader, not a banker, would take the lead at Goldman Sachs. Gus Levy had an energy that seemed limitless. He arrived at his office before the sun rose, surrounded by secretaries and traders who worked tirelessly alongside him. Goldman Sachs was his entire life, and he expected the same level of devotion from all those around him. Under the leadership of Gus Levy, the trading division grew at an impressive rate, evolving into one of the firm's largest and most profitable operations. However, swift expansion brought with it peril. As Goldman Sachs issued and traded an increasing number of securities, the risks grew. In the realm of finance, regardless of how big or influential a company may appear, a single miscalculation could lead to its downfall. And soon, Goldman Sachs would make that very kind of mistake.
In 1968, the Pennsylvania Railroad merged with the New York Central Railroad, creating Penn Central, the largest railway company in the United States. Despite already carrying an enormous debt of over $1 billion, Penn Central needed even more money to stay afloat. The company sought assistance from Goldman Sachs. Goldman Sachs agreed to issue $100 million in commercial paper on its behalf, assuring investors that the debt was secure. Since the notes bore the Goldman Sachs name and received a favorable rating from the national credit agencies, investors hurried to purchase them. To the market, Penn Central appeared far too significant to collapse. Yet behind the optimistic figures, the company's tracks, trains, and infrastructure were deteriorating quickly. The income struggled to match the costs, and the fissures in the empire grew larger until the unavoidable downfall occurred.
When Penn Central declared bankruptcy, it sent ripples through the financial world. The investors who had placed their trust in its commercial paper faced near devastation, and lawsuits soon emerged. Goldman Sachs faced accusations of misrepresentation of selling debt that was already destined for failure. The irony was difficult to overlook. The very credit agencies that awarded Penn Central elevated ratings had done so primarily because Goldman Sachs had supported the deal. Goldman Sachs had, in turn, encouraged the company to issue even more debt, feeding a cycle that ended in disaster. Ultimately, Goldman Sachs was instructed to compensate investors at 20 cents for every dollar. To numerous observers, it appeared as though Goldman Sachs had anticipated the danger long before anyone else. The Penn Central scandal emerged as a cautionary tale, a preview of what was to come. As the economy struggled during the 1970s, an increasing number of securities backed by Goldman Sachs started to collapse, exposing the delicate nature of success in the realm of high finance. After the downfall of Penn Central, Goldman Sachs encountered a number of expensive challenges. The firm was repeatedly forced to pay a significant amount in settlements to companies like Getty Oil and the University Hill Foundation, making amends for deals that had not turned out as planned. Yet nothing could prepare Goldman Sachs for the loss that would soon strike at its very core. For many years, Gus Levy had appeared untouchable. He transformed Goldman Sachs from a conventional investment bank into a prestigious institution characterized by discipline, ambition, and a strong desire to excel. However, constant pressure and a demanding schedule had their impact. While on a business trip, Gus Levy experienced a fatal stroke. His unexpected passing sent ripples of disbelief throughout the company.
Gus Levy had not designated a clear successor, nor had he established a formal plan for who would take the lead following his departure. In the days that came after, uncertainty held a tight grasp on Goldman Sachs. Yet within the company, one name emerged: John Whitehead. John Whitehead, a man with a Harvard education and a former Navy commander who participated in D-Day, was recognized for his integrity, precision, and calm authority.
When John Whitehead took on the leadership role, he recognized right away that Goldman Sachs could not keep functioning in the same way it had during Gus Levy's time. The company required a framework, a feeling of order that transcended the desire for profit. Drawing from his military background, John Whitehead introduced a new ethos centered on order, accountability, and respect. On a Sunday afternoon, John Whitehead took a seat with a yellow notepad and started to write. Line by line, he crafted what would evolve into the guiding philosophy of the firm, the principles of Goldman Sachs. These principles shaped the way employees were expected to behave, the manner in which they would assist clients, and the approach the company would take to maintain its reputation. Above all, John Whitehead emphasized a single rule: the interests of clients must always come first. Under his guidance, Goldman Sachs started to function more as a cohesive unit rather than a casual partnership. John Whitehead's reforms provided the firm with a moral and professional foundation that would support it through the unpredictable decades to come. John Whitehead's leadership style was both disciplined and demanding. On one occasion, John Whitehead set up a meeting for 5 o'clock on the Friday before the Memorial Day weekend. His team gathered on time, but the guest arrived 5 hours late at 10 o'clock that evening. When the man finally walked in, he smiled and said, "Today's lesson is about patience. One day, when you find yourself waiting to meet a billionaire, he will have you waiting in his lobby as well. You must be prepared for that." John Whitehead recognized that in the world of business, maintaining composure and showing endurance held as much value as having intellect. Under the guidance of John Whitehead, Goldman Sachs transformed into more than just a profitable enterprise. It evolved into a symbol of reliability and trust. His insistence on professionalism and integrity brought back trust among clients who had previously questioned Wall Street. He understood that achieving lasting success in investment banking demanded not only ambition, but also a commitment to exceptional service and a reputation that remained untarnished. The timing of John Whitehead's leadership was just right. The 1980s brought about a time of easy credit and relaxed regulation, a decade characterized by mergers, acquisitions, and corporate growth. Companies throughout America were eager to buy, sell, and consolidate, and Goldman Sachs was ready to take advantage of every opportunity.
The advance of freedom and democracy.
After many years of crises and recoveries, Goldman Sachs emerged as one of the dominant forces on Wall Street. By 1983, under John Whitehead's steady leadership, the firm reported profits of $400 million, a 60% increase from the previous year. Goldman Sachs had not only endured, it had emerged more robust, disciplined, and ready for an even brighter future. At the height of his influence, John Whitehead chose to step back from Goldman Sachs. He departed from the firm to dedicate himself to his country as the Deputy Secretary of State under President Ronald Reagan. His departure marked the end of a significant period of stability and discipline. But his successors, Steve Friedman and Robert Rubin, were prepared to carry the torch into a new, more aggressive age of finance.
While the world watched
Robert
Levy
Rubin,
and Coca-Cola
sharp and forward-thinking, built Goldman Sachs's options trading division from the ground up, transforming it into one of the firm's most profitable engines. Under his guidance, Goldman Sachs flourished in the dynamic and risky realm of derivatives and intricate financial products. Robert Rubin believed the firm had limitless potential, confident that Goldman Sachs could only rise higher. Yet an unforeseen challenge was about to emerge from beyond the realm of finance. In 1987, a senior partner at Goldman Sachs named Robert Freeman faced arrest due to charges of insider trading. A few years prior, Goldman Sachs had acted as the underwriter for KKR's aggressive acquisition of the Storer Broadcasting Company. During that deal, Robert Freeman reportedly shared confidential pricing information with a friend, enabling the friend to gain from call options. It was a classic example of insider trading, one that, in typical situations, could have slipped by without anyone noticing.
However, on this occasion, it captured the interest of an emerging political figure, Rudy Giuliani, the driven United States lawyer for the Southern District of New York. Recognizing a chance to establish his reputation through a prominent prosecution, Rudy Giuliani chose not to manage the case discreetly. Instead, he transformed it into a public spectacle, apprehending Robert Freeman in a dramatic manner and feeding the story to the press over the course of several months. The scandal was truly devastating for Goldman Sachs. Its reputation, established over 100 years of trust and carefulness, was tarnished. For a company whose success relied completely on the trust of its clients, such harm could have been disastrous. Clients were hesitant, deals slowed down, and doubts started to circulate throughout Wall Street. Goldman Sachs was encountering not merely a legal crisis, but a crisis of trust.
Even in the midst of chaos, the clients of Goldman Sachs chose to stay committed. American corporations held one thing in the highest regard: results. As long as Goldman Sachs kept generating profits and showcasing strong performance, controversy was just background noise. The company had cultivated an impressive knack for bouncing back from challenges, coming out even more resilient with each experience. Robert Rubin once more demonstrated his talent when faced with pressure. He successfully guided Goldman Sachs through the chaos of the Black Monday market crash in 1987 and steered it safely past the legal storms of the early 1990s. His calm precision and ability to balance risk with diplomacy earned him deep respect both on Wall Street and in Washington. Similar to John Whitehead before him, Robert Rubin ultimately departed from the firm to pursue a career in public service, becoming a trusted economic advisor in the U.S. government and later serving as Secretary of the Treasury. By 1993, Goldman Sachs achieved remarkable success, reporting profits of $2.7 billion, primarily driven by trading activities. For many years, the firm had operated on the principle that the client's interest came first. However, as Goldman Sachs's own trading operations grew, that philosophy started to become less distinct. Gradually, the firm began to rely more on its own capital, assuming substantial positions in the markets instead of just facilitating trades for its clients. By the middle of the 1990s, Goldman Sachs controlled almost $100 billion in total assets, while its partners' own capital amounted to just $2 billion. That great leverage brought great risk. The framework that had supported the partnership for over 100 years was starting to exhibit signs of stress. A number of senior partners were retiring, taking their personal capital with them, which left the firm facing an increasing need for permanent funding that could not disappear overnight. The answer was clear. Goldman Sachs would need to go public. However, this action brought about a challenge. By 1997, the firm was jointly led by two influential individuals, John Corzine and Hank Paulson. The dual leadership model had been effective for many years, but a publicly traded company could have just one leader. A quiet rivalry began to develop between them, and Hank Paulson was resolute that when the moment arrived, he would be the one to don the crown. Hank Paulson frequently portrayed himself as a child filled with fierce competition, motivated by what he referred to as his gold star mentality. He didn't just aim to learn, he aspired to excel, to achieve the highest mark in all his endeavors. That determination carried into adulthood. Hank Paulson, a devoted Christian, adhered to a personal code of discipline and integrity, applying these principles consistently in both his private life and his professional endeavors. Within Goldman Sachs, Hank Paulson established a reputation as an honest and dependable dealmaker. His clients appreciated his honesty and reliability, remaining loyal to him during tough market conditions and challenging negotiations. Hank Paulson never mapped out his career with grand designs. Rather, he dedicated himself entirely to the task at hand, convinced that full commitment led to achievement. However, not everything within the firm was smooth sailing. The relationship between Hank Paulson and John Corzine, who co-led Goldman Sachs, became increasingly strained. As their visions for the company started to differ, eventually, the partners of the firm found themselves having to make a choice between the two. They ultimately chose to align with Hank Paulson, appointing him as the only senior managing partner and the unquestioned leader of Goldman Sachs. Under his command, the firm achieved almost $3 billion in pre-tax income in 1997, and all signs pointed towards a new era of expansion. The company was at last prepared to take the step of going public. But just as Goldman Sachs got ready for its big moment on the stock exchange, an unexpected disaster appeared on the horizon. A hedge fund called Long-Term Capital Management, established by John Merriweather, a renowned bond trader from Salomon Brothers and supported by some of the brightest economists globally, was nearing its downfall. Long-Term Capital Management had constructed its empire on intricate mathematical models, crafted to take advantage of small inefficiencies in worldwide markets. The founders held the belief that by merging specific risky positions, they could completely eliminate the associated danger. In its first year, the fund posted astonishing returns of 40%, attracting Wall Street's biggest firms to trade alongside it. Yet, markets possess a unique ability to humble even the most brilliant of minds. As the ancient proverb suggests, the market will consistently challenge you and do exactly what you least anticipate. In 1998, a rare and devastating event struck the global markets, what economists would later call a black swan. The disaster originated from an unforeseen source, a nation failing to meet its debt obligations. In the month of August in that year, Russia, which is one of the largest economies in the world, suddenly declined to repay its international loans. The decision sent shockwaves through every corner of the financial world. Long-term capital management, the hedge fund that thought it had conquered risk with the power of mathematics, was caught off guard. The models on which its empire relied had never considered the chance of a national default of such magnitude. In a single day, the fund lost $353 million, unraveling years of calculated precision. When Goldman Sachs became aware of long-term capital management's difficulties, it responded quickly. In order to safeguard itself, the firm started to sell off its own bond holdings in the market, a move that intensified the panic and hastened the downfall of the hedge fund. Chaos spread across Wall Street as financial institutions faced significant losses, and the possibility of a complete market breakdown loomed large. At the last moment, the Federal Reserve intervened, organizing a bailout of $3.5 billion to prevent a financial chain reaction. The rescue ignited anger among critics who wondered why taxpayers were indirectly bailing out billionaires from their own irresponsibility. Yet for Goldman Sachs the outcome was evident. The firm had endured once more. Survival was the only thing that truly mattered. With the long-term capital management crisis behind it and the dot-com boom in full swing, Goldman Sachs finally seized the moment it had been preparing for. During a time of great market excitement, the company made its public debut, shifting from a private partnership to a global powerhouse listed on the New York Stock Exchange.
A new era of wealth is beginning.
1999 marked the end of an era.
As the final months of 1999 drew near, a sense of anticipation enveloped Wall Street. Goldman Sachs was on the verge of making its long-anticipated public debut. When the initial public offering took place, the firm sold 11% of its shares, raising $3.7 billion in capital. It was the conclusion of a century-long era as a private partnership and the start of a new chapter as a publicly traded corporation. Going public meant Goldman Sachs had to open its books for the first time, revealing details the financial world had never seen. The figures stunned investors. In the 5.5 years leading up to 1998, Goldman Sachs had earned more than $12 billion in pre-tax profits, most of which had been paid out directly to its partners under the old structure. Now, with fresh access to public capital, the firm was eager to discover new, even more lucrative ways to generate income.
It was the dawn of a new era. Mortgage-backed securities, once obscure...
By the beginning of the new millennium, one business emerged as a standout above all others: mortgage-backed securities. In the financial industry, home loans transformed from mere lending instruments into tradable products, bundled and sold as investments. Many Americans, yearning for their share of the American dream, secured mortgages that were just beyond their means, spurred on by accessible credit and rising property values.
Mortgages were bundled together and sold as ironclad investments.
The surge escalated into a whirlwind of excitement. By 2006, mortgage-backed securities had emerged as one of Wall Street's most lucrative innovations. In a span of merely 2 years, Goldman Sachs underwrote more than $200 billion worth of these instruments, raking in astonishing fees as the housing bubble continued to swell.
Keep the pipeline full.
At the height of this success, Hank Paulson once more adhered to the established Goldman Sachs tradition of its leaders transitioning into government service. In a public announcement from the White House, President George W. Bush named him as his nominee for Secretary of the Treasury, praising Hank Paulson's deep knowledge of financial markets and his ability to navigate complex economic issues.
Paulson played it safe. We're going where the leverage is, gentlemen.
With Hank Paulson's departure, leadership passed to Lloyd Blankfein, a seasoned trader who had risen through the ranks of Goldman Sachs's trading division. During the tenure of Lloyd Blankfein, Goldman Sachs began to act less like a conventional investment bank and more like a large, advanced hedge fund, one that was prepared to wager on and against almost every facet of the global economy.
Returns were in the sophisticated risks, not the steady fees.
By the middle of the 2000s, Goldman Sachs had transformed into something much more than a conventional investment bank. The firm managed countless billions of dollars of its own capital, investing and trading on a scale that blurred the line between client service and proprietary ambition. Throughout the extended bull market, this change mostly flew under the radar. But no market remains prosperous indefinitely, and soon Goldman Sachs's most valued principle, prioritizing clients, would be challenged by a tempest unlike any it had encountered before.
Client service and pure ambition. The dream was dead.
The storm started when the housing market fell apart. Throughout the United States, countless Americans found themselves losing their homes as mortgage payments climbed beyond their ability to pay. Over 70 mortgage lenders failed within a few months, and panic spread through the financial system. What had once been celebrated as a remarkable breakthrough transforming home loans into assets that could be traded was uncovered to be a delicate structure resting on poor debt.
The unthinkable had happened. Lehman Brothers was gone.
The crisis deepened as the giants of Wall Street started to tumble. Bear Stearns fell apart and was sold in a hurried sale to J.P. Morgan Chase. Lehman Brothers, a name with a long and respected history in American finance, declared bankruptcy, which set off a wave of panic around the world. The whole investment banking sector was on the edge of disaster. Goldman Sachs, deeply involved with mortgage-backed securities, suddenly faced the threat of extinction. As markets spiraled and confidence vanished, the world found itself on the brink of a complete financial collapse. In a time of great uncertainty, Goldman Sachs sought help from an unlikely source, Warren Buffett. The legendary investor's multi-billion-dollar injection of capital provided a vital lifeline, helping to restore some trust in the firm's future.
As the market teetered on the brink, this handshake symbolized the legend.
Amidst the fog of the financial
However,
crisis,
Goldman Sachs did not halt its efforts there. In an effort to bounce back from its trading losses, the firm took the step of selling off its mortgage-linked assets. In a move that sparked debate, it also began to bet against those very assets, by utilizing complex financial instruments referred to as credit default swaps. In effect, Goldman Sachs gained from the very collapse that was devastating the global economy, ensuring its survival at a time when others fell.
Long before the crash occurred, Goldman Sachs recognized the impending danger. In December of 2006, the firm's traders started to understand that the housing market was constructed on shaky ground. In a swift move, Goldman Sachs made significant proprietary bets against the mortgage market, setting itself up to gain when the unavoidable collapse came. The decision was clever from a financial standpoint, but when it comes to ethics and reputation, it was harmful. Goldman Sachs kept selling mortgage-backed securities to clients, while simultaneously wagering that those very investments would not succeed. Critics have accused the firm of being deceptive, arguing that no company should benefit from the losses of its clients. Goldman Sachs stood by its position, stating that if a client requested a particular derivative, it was the firm's responsibility to develop it, emphasizing that the actions of the trading department were distinct from client service.
As the final months of 1999 drew near, a sense of anticipation enveloped Wall Street. Goldman Sachs was on the verge of making its long-anticipated public debut. When the initial public offering took place, the firm sold 11% of its shares, raising $3.7 billion in capital. It was the conclusion of a century-long era as a private partnership and the start of a new chapter as a publicly traded corporation. Even with its damaged reputation, Goldman Sachs persisted in maintaining its dominance. The firm's clients, a significant number of whom were influential corporations and governments, stayed loyal because the firm provided what they cherished most: results. The secret behind Goldman Sachs's survival was its remarkable knack for predicting trends, capitalizing on them quicker and more efficiently than others, and withdrawing before calamity hit. As history repeated itself, the cycle of boom and bust once more reshaped the markets. By 2018, the United States found itself on the brink of yet another wave of speculative growth, this time fueled by a fresh generation of retail investors. Platforms like Robinhood opened the markets to countless everyday individuals, and money was flowing in. Ever opportunistic, Goldman Sachs spotted yet another chance to broaden its empire, this time venturing into consumer finance.
The Marcus Invest initiative represented
By 2020, a new kind of investor had taken over the financial landscape. The retail investor, previously overlooked as minor and unimportant, had now become a powerful influence on markets around the globe. To adapt, Goldman Sachs, a company that has been linked with the elite and the ultra-wealthy for many years, chose to open its doors to everyday individuals. The firm introduced Marcus Invest, a platform for automated wealth management aimed at making professional-level investing accessible to everyone. It was a meaningful gesture, indicating that even Wall Street's most prestigious institution could adapt to the changing times.
In the year after 1921, the world had changed dramatically, economically, politically, and technologically. Yet Goldman Sachs stayed surprisingly consistent. Underneath each rebrand and fresh strategy, the essence of the company remained the same: hungry, relentless, and opportunistic. The culture that Marcus Goldman had built over 100 years ago still defined the firm, an unbreakable drive for perfection, precision, and above all, profit. In the ongoing struggle for supremacy, Goldman Sachs has endured against competitors, navigated through crises, and reinvented itself repeatedly. It stood as proof that in the survival game of global capitalism, discipline and adaptability are the true currencies of power. For Goldman Sachs, as always, everything came down to one enduring principle: profit above all else.
You must dominate or be consumed by it.